Good morning, everyone. This is John Person. All right, so planning and scanning. This is an interesting situation that we have. First couple things that we want to go over is the S&P's day-to-day. We've got kind of a really complexing story here, folks. First and foremost, we had a low close doji over here, breakdown in the AD lines, if I may show back as I'm preparing to tee this up for you, back in February with the decline in volume, decline in the advancer stocks versus decliner. We seem to accelerated that level of stocks falling more than rallying as we got into this peak. And then the next day we rallied. So the market kind of gave a false heads up. The market rallies back up. The volume doesn't exceed the prior time period's highs, as you can note that similarity. So we come forward to the current time period where we got a low close doji. This week was very interesting in the sense that depending on which commitment of traders data you were looking at, big S&Ps, little S&Ps, big S&Ps with options, little S&Ps without options, little S&Ps, of course, with the options. There's several different concepts that you can look at. The one that we follow showed clearly that last week the small speculators were in an extreme net large position, pretty much long twice as many as they were short. It's a pretty sizable position. 16% of the net open interest, or 16% of the open interest was attributed to the longs in the small speculator category. But let's take a look at the difference here. Number one, we didn't see a major decline in volume on this breakdown over the last few days. The advanced decline has. We formed kind of a bearish divergence in the sense that the market's made a attempt at a newer high, and the advanced decline, of course, has not. So that leads us to not having the same type of situation as developed back in February. And in February, that low close doji resulted in about a almost 3% decline from trigger of selling to the low of the move. Okay, so that's a 3% correction. Now let's go over to the weekly and say, well, what did the weekly cumulative analysis look like? The weekly analysis does share a startling situation in the sense that cumulative advanced decline, while the market tried to rally over the last week and a half, we actually made a cumulative lower low in the advanced decline reading in the S&Ps. Volume did move down, but it's still forming higher highs and higher lows. Seasonally, we really get into like the worst time of the year, right around early September, or excuse me, early July is a kind of a peak. So give or take a week or so in this market. I'm thoroughly under the camp that I think, as I described last week, and I wrote, and I'll keep this here, because I think between July, if we peak out or get one more rally over the next couple weeks here, if the market does have the capacity to regroup and gain some strength, I think that we are going to see there's a strong potential for a minimum of 5 to 8% correction between July's peak and I'm going to say mid-October's low. And I see a maximum of a 15 to 20% correction because we just haven't seen one since the 2011 pullback. Typically, some of my longer-term research indicates after a few criterias occur, we get more chances of a deeper correction in the 15 to 20% nature. While it may not stay there, it may do what it did kind of like last year. And in last year, if you recall, back in September, the market had a kind of a false breakout high, and then we had a real scare to the downside. Now, that was approximately a 9% correction. We were last year, if you were here with our trading room, you know that we were positioned on the short side of that move. We covered our positions, covered our shorts, that is, liquidated the long puts we were in, and we actually reversed and went long according to our analysis in the Russell, the IWM. In fact, you can go back and look at the tweets on our Person's Planet Twitter account to go back and check that all out. And one stock I actually jokingly I put out a funny tweet was maybe we could take some of those profits and instead of buying a boat with your profits, buy a stock in a boat making company. HCO was the stock symbol, and that's MarineMax. Boy, I wish I'd adhered to that advice and stuck with the stock longer, because let me share with you what that kind of looked like. It was a pretty amazing move for a small cap stock. So I'm teeing this up for you right now, and this is the time frame of MarineMax. This was that buy signal that occurred in October, and it did have a nice move. Didn't do anything until we got into the end of January, and as you can see, from the time I actually recommended to go long MarineMax to the actual high, a 52% move appreciation. The funny thing is now it's you know, on balance volume is decaying. The seasonal tendency is to go down, and that particular stock is moving lower, just as a follow-up to that analysis. So what is my main thoughts here in the market? Looking at the Qs, the NASDAQ 100, it's been holding up relatively well, number one, but I think the advanced decline analysis has had us a little spooked. More importantly, this might just be where we see more relative weakness in the other markets. On a weekly chart, we did actually make a new low in the advanced decline. Now there's 103 stocks in the Qs, so what it kind of looks like here, as you can see, we actually made newer highs in the market right here. And when the market made newer highs, it had less breadth, less participation. And this is not a daily chart, again, folks. This is a weekly chart. And with that said, when we go back and look at this very strong upthrust here, you will note that we still have relative, and I'm going to just compare an apple to an apple. I'm going to go right on the crosshairs. And you can see from that time period here, the volume levels now are lower. And as you can see, the advanced decline levels are lower, and the market did try and make a unsustainable newer high over a period of time. 1, 2, 3, 4, 5, 6, 7, 8 weeks, 2 months. The markets had to try to make attract new buyers into the market, attract new highs in the stocks that are contained with this index, and it has not managed to do so. So this, to me, is a fairly negative pattern. Seasonally, it doesn't look good. Seasonally, we actually, in the technology space, tend to move lower going into October, and you want to be monitoring this through the next few weeks. Now, it's coming upon us that in the middle of the week, we begin a new quarter. And so right now, Genesis Software is giving us the criteria that we're still in a longer term or quarterly potential buy setup, as the indicators are saying the market trend is still strong. So it's not giving us a longer term flip to the downside. But that doesn't mean that we can't go, if we went back to the 3-period pivot support, that would be almost a 5% correction. And then we'd be watching our changes in our monthly, which, again, we have a new month coming up. Note one thing that I will show that I see is that the relative distance between the blue and the gold has been narrowing, and it's starting to go from strong bullish trend to now more neutral. And that, to me, is another cautionary flag. So we go to one last main sector just to give you a monthly, because we're coming into a new month, we're coming into a new quarter, and we look at the IWM. The IWM represents the small cap, and I think what's been happening here in the small cap biotech sector, it's been really weighing in on this particular market, because we have a numerous amount of stocks that are contained within the Russell that are at or near 52-week lows, by the way. One case in point is a stock many of you know in the consumer discretionary sector. You could take a look at some of the casino stocks for one. You could take a look at Green Mountain Coffee Roasters for two. It's a pretty substantial list that's starting to climb. So while the index makes newer highs, we aren't seeing the breadth actually make an enormous move with that. But we did see volume shoot up. So this is one that's kind of a little confusion for me, that in the sense that if we are entering the seasonally worst period of time to even be buying this sector, and it decides that it's going to be into a profit-taking mode, number one, we'll probably get back down to test the 121 level, and then we could probably come back and test on the chart support levels, you know, down here in the 115 handle. Type of correction that would exist if we got down to around that 115, a 10%. If we get back down to the lows where we were just in May and stay in kind of a range, almost a 6% move. So that just to adjust any type of ideas or positions or trades for you. If you're buying deep out of the money options, just remember to make money on those at expiration, what do you need the market to correct? How much downside do you need the market to correct to actually pull off a profit on buying deep OTM puts? Deep OTM, again, standing for out of the money, OTM, okay? So moving forward, I want to address the NYSE on a monthly basis because, again, here in the NYSE, volume picked up, which this is really strange because while the NYSE, if you note the level was actually positive on the week. The NYSE actually picked up again this week. It doesn't look like it because of that red candle, but that red candle only signifies the market closed below the weekly open. You will note, though, we have a difference of a divergence here between indicators. Volume was strong, picking up from these lows, but the amount of stocks participating in the rally was weaker. In fact, we made a new lower low reading. So what you really want to pay attention to is this possibly the process of an A-B-C-D wave? A, B, you take that level and you measure it from the low to the high, would be C, and then, so it's A, B, C, and then D equates to the move from the peak of A to the bottom of B, add that to the high of C, and D gets you your price objective. So if the market has more downside to it and comes just down to about the current support, number one, we're only talking approximately a 2% move to the downside in the next few weeks. Now, I'm sitting here going and looking at the Dow Jones Industrial Average, where this is another index that, to me, also confirms relative weakness, which we need to respect. But again, there have been times where we've seen relative weakness in the advanced decline analysis, and it has caused several weeks of decline. So here's a time period that we got back in January. The market came back up. It was a little different of a scenario in the sense that it already started a downturn. The volume was starting to downturn. And while we did have 1, 2.5 or so weeks of continued weakness, it really didn't go anywhere, number one, didn't break support, number two. And that's kind of the situation here. We're down below the AD lines. There's no real volume behind the sell-off. So you really want to watch for this market, in my opinion, is if in the Dow, we start to see daily closes underneath this in the diamonds, that is that 174, let's call it and a half. Let's just call it what it is. We close underneath the April lows, and I think now you're on to a bigger and better downside action. I'm very cautious here. I want to look at, since we are coming to the conclusion of the end of the month, let's take a gander at how the monthly longer-term charts fare. Let's get rid of the pivots. That hurts my ego, I know, but let's just take a look at the market and say what's really going on. We've had a long stellar advance in the marketplace. Along the way, we've had slight pullbacks, and remember, through this whole upside move, we've had many people say the top is in, it can't go any higher, and it continues to blister to the upside. So for those that in the last, say, year and a half who have been, managing to tell their investors stay out, they've missed a 30% move in the upside in the Dow in just approximately a year and a half. Think about that, folks. A year and a half is not that many months from I mean, in reality, what are we talking? 18 months, 30% of your money because people said the market was going to crash? Now I think what is in existence is there's so many people compelled to believe that the stock market's impervious to any type of correction, and it's kind of like the boy who cried wolf scenario. Now, what causes markets to go down? Anticipation of big changes in economies, contraction in profits from corporations. A lot of dynamics can change the landscape of a market that can create the beginnings of a bear market. A recession, 2 quarters back-to-back of negative or zero growth, that's another reason. Well, we really don't have that, but boy, I'll tell you what, when I look at the strength of the market, unlike any other time in the past, we've seen the advanced decline come and test the moving averages, and now this is the first time that we're not just testing the moving averages, but what I'd like to point out to you is that the advanced decline analysis that I'm sharing with you here is actually, since November, diverged. There's divergence. We've made higher high. A lot of stocks aren't participating, and now it's crossing below its monthly moving average. And to me, my friends, it gives me a more solid impact of being extremely cautious, tightening up your stops, protect your profits. Let's take a look at what the monthly analysis looks like on the NYSE. It gives you kind of a different picture here than the weekly shorter term. And I think when you go back and you say, yeah, I think John talked about the monthly charts every time a month ends, and boy, we had a little doji here. That means within 3 months. So you have now what? This doji here was in May, so you have June, which we're concluding, July, and August. So within the next, 3 short period times, we want to watch this range of this candle. A monthly close underneath that low, folks, I'm not looking at a very healthy situation. Now when we take a look at the volume on the rally, you can see clearly we have divergence. So the market has been trying to rally and make newer highs, and we see a rollover on the AD lines. We see a little divergence on the longer term stuff, and that's on the NYSE. Now we take a look at the Russell, the real strong one, the one that everyone says that this is where the smart money's been going, and that's true. And we do have a continued higher high in the AD lines, and we do have strength longer term confirming the volume to the upside. The only difference is it's in probably the worst seasonal time frame of the year to be long this, and it's more than likely to be looking at a shorter term correction. If all the other indexes is going down, I can't imagine people pouring money into switching from a stock in the Dow, which pays dividend yield, to a growth stock in the small cap sector. Needless to say, let's take a look at the NASDAQ 100. Very similar spooky situation longer term. Definitely have divergence with the market making newer highs on lighter volume, and we can clearly see we have the AD lines presenting themselves with kind of weakness here. Last but not least, just to give you a monthly outlook on this, I look at the divergence, again, another index, divergence on volume. I have also a clear-cut sign of stocks not moving up strongly in the AD levels, with the indicators that share with us that it's almost flatlined as prices have accelerated to the upside. That means it makes it very susceptible for sharp downturns. So the key is this year, or this month in July, that I think we need to be more cognizant and aware that we have actually gone up a very long time in the marketplace without any meaningful correction. And the longer that we do see, and this is where the difference is, from the point of breakout is 1 year, 2 year, 3 year. We're 3.5 years without any sustained meaningful correction of more than a few days. I mean, seriously, in October it was more like a few days. The market broke and came right back. If this is a monthly chart, you're talking maybe 20 days, not 2 consecutive or 3 consecutive or 4 consecutive monthly periods, 16 weeks. Here, again, a correction, 1 month, 2 month, 3 month, 4 months. A correction, 1 month, 2 month, 3 month, 4 months. So as you can see, corrections can and do exist in the marketplace. There's a pause. And so this is where I feel, based on the longer term analysis, we have had too long of a sustained uptrend. We're due for that correction, and now we have some more testifiable indicators suggesting it's probably closer to that downturn than it has been at any point in the past. So I wanted to go through that with you, number one. Next, that's a kind of a special month since I'm on vacation. I want you guys to have focused in on that, get some levels. This is recorded. You can watch it again. Keep in mind some of the support and resistance levels that we want to look at. Now let's take a look at inverse ETFs, because they may give us a little different picture of the market. So I'm looking at SDS real quick. This is the inverse ETF to the S&P 500. Now, interesting enough, I've got a daily chart lined up with my monthly pivots. I got a weekly chart with my quarterly pivots, and I got a monthly chart, and I still have quarterly pivots overlaid. Interesting, it looks very kind of like a beginning of a kind of a rounding bottom type pattern, as you can see. And you can also note that on a monthly chart, we've got that bottom base of volume. So it looks like as the market's been trying to go up, the inverse ETF is trying not to go down. And when we look at the weekly volume here, you will note that we're starting to lose that kind of negativity in volume. Prices made newer lows, but not on strong volume. And you can see clearly we start a kind of a seasonal upturn. Looking at the daily chart, we have a daily PPS buy signal. We have high closed dojis. And for me, really, to get things kicked off, you get closes, I would say now, we've tested so many times the resistance up here, resistance up here, the resistance up here. I think now making this bullish convergence type pattern where the price made almost a deeper low on lighter volume, I think this now gives a very strong case to say, gee, why don't we look at maybe a hedge or look at SDS. So this is one way of looking at the market. Clearly, if this is an Arthur Merrill who did an extensive study on W bottoms and M tops, some would argue that this made it did not make a true W bottom formation because it made a slight new lower low, and I argue that's not necessarily true, since even though it did make a new low, it never closed underneath the old low level, as I can share with you. It never closed underneath that level. So now we're up. So I think in the next week, couple days, any slight pullbacks, if you can get you've had 3 strong up days, if you can get maybe a Monday or a Tuesday pullback into the daily MAs, it might make sense to start looking at pricing out some position in SDS for a slight protection or options in SDS. In addition, a breakout on a W bottom pattern would come from that swing high right there. Going forward, if you take out the swing high and you get the market above, you know, what do you look forward to? Well, first objective would be 22, and then the next objective would be somewhere up near the 23.5 area. All right, last but not least, let me look at TZA with you real quick. TZA is also the inverse ETF on the Russell. So it has clearly a dynamic upside swing. The volume on a longer term, as you can see, doesn't constitute a huge bunch of divergence or love to give me an argument about, hey, it's a false bottom. In other words, it probably might have a chance at making one more newer low. The weekly has kind of like the same flavor. It's been going down, and the volume's been going down, matching price. When I look at the daily, and the fact is that we came right to monthly support on TZA, and we have a buy signal, my feeling is that if you get closes over $9.30, that's the last conditional change. It also is almost an, what? On the average of the highs, not absolute highs. You know, we don't teach drawing trend lines on absolute. We teach how to draw a trend line on the average of highs here. And you will note that if we do we have a buy signal at support, a breakout above a trend line, and above the last conditional change, we have a trilogy set up. So TZA could be a nice way of looking at another form of watching for a correction in the market and participating in options or a position in this exchange traded fund. One other one, I want to look at FAZ because the financials have really rocked to the upside. It's led this market. We were long Bank America back in late April, had a great move there. And now I look at the seasonality for financial stocks, and you know, it's not really that great, but we don't have a weekly trigger. We do have a very similar pattern in the sense that the Russell, where it didn't take out its prior lows of 2013. It also has a very similar makeup in the sense that the volume also has made newer lows. This is a very similar pattern, FAZ, which is the inverse ETF on the financials, versus looking at the TZA, which again was the last instrument I demonstrated, which is the inverse ETF on the small cap sector represented by the Russell 2000. So let me go back and just share that with you in case I went too fast. We want to look at, again, the TZA. Again, clearly see that this is not the same chart. This is the TZA. It's the inverse ETF, again, on the Russell 2000. Price is coming close to, but didn't take out prior lows. Volume is heavier. Now let's look at FAZ. FAZ, the financials. I mean, it's almost as if I didn't need to put the chart lines back in the game. They're still there, and this, as you can see, clearly FAZ. So FAZ looks a little bit different in the sense that if you compare the trend of this market, right, and you look at the volume on a short term, you go, wow, that's pretty interesting. How come there's not been a lot of selling pressure in here? There is volume. It does trade. You can see it in the volume histogram bars, but it's just the matter of when the market goes down, it spikes up. When the market goes down, it spikes up. When the market goes down, it spikes up. It really over time, it really hasn't made, while it might make a short-term 2 or 3 day plunge, it comes right back up into value. It means it's being accumulated down here. People are using this as a hedge. These are now very inexpensive options. That to me is or very inexpensive, not options. It's very inexpensive inverse ETFs, and it's almost like an option premium. That's what I really meant to say, excuse me. So I think that there are a couple pockets here of areas that you could look for if we see a downside action, not to chase markets in the main indexes, but now start to focus in on the chart patterns on the inverse ETFs. So if the hedge funds are maybe coming in and high frequency traders or managed traders are coming in and now starting to find value in putting on hedges in some of these inverse ETFs, both in the Russell, the S&Ps, as I mentioned, SDS, as in the Russell with TZA, and the financials with FAZ, you probably might get some really smart low-risk trades out of there to participate in a correction in the market. So last but not least, when we take a look at the ETF that tracks actual NASDAQ, so this is the QLD. And the QLD, which had a split, as it shows you here, I mean, it had to split. It was ridiculous, right? But when I look at the QLD, and I can see that, you know, since the last 2 months, we had that split, you know, that volume is going to skew things. But when I look at the day-to-day operation on QLD, and I note that it just looks like rounding top, rounding top, rounding top, rounding top, rounding top. It looks like one massive umbrella. And this, to me, is not a very healthy market environment. It seems that there is more distribution in less accumulation. Let's take a look at a couple stocks that we've talked about in the trading room in the past. Apple. Whether Apple Music makes it or not, I can tell you this. We have had a couple of sell signals here over time. We look at our the way the market's been responding to those sell signals. It spiked up into the weekly MAs. It pulled back. Looking at the daily chart, I can tell you this little swing line, which indicates the little troughs or the spike downs, it rallies, spike down. That's 124, break this swing low in a closing manner. If you get a close under 122, I do see this little gap under the market near 112. When I look at the monthly chart, I go, is it possible we had a doji? People may forget. There was a doji just 2 months ago. A close underneath that doji at 120, definitely we could see further downside. What's that doji low? That doji low is 122.59. So 122.59 is really 122.59 is pretty damn close to, darn close, excuse me, to that low right there on a monthly basis. So I think that these two levels here, we really got to be focused in on for daily downside action. And I think that's where people may get blindsided. I really get worried on a major stock that should be leading its sector, and relative strength shows it's not leading its sector. In fact, what it is doing, it's been weakening as the stocks have been rallying. And so what would happen if this thing did see a nice little correction? Is it possible that we could see a move getting back into this gap level? I think the answer is clearly yes, because not to raise the scare, but we're trading volume levels. We're back to volume levels, just to compare an apple to an apple. We're at volume levels up here. As you can see, the OBV is at volume levels when price was right here. So that's just, what, 117, got $5 more just on an accelerated downside. Come in, fill the gap, midpoint of that. This over time is something of a reality. Another stock that we've talked about in the room, MSFT, Microsoft. Here we go with Microsoft. Again, wow, this to me is another kind of scary market. It may have the chart pattern of a potential continuation breakout, but boy, we gotta close above these swing highs here, above this 47 handle, to get really excited. Huge gap below the market here. Again, this gap exists on a multiple weekly basis. So as you can see, old highs, another gap in the market here, huge gaping hole right there, huge gaping hole right here. But boy, look at the volume level with me, friends. The volume level to me is another scary scenario, because when I look at the market and I say, okay, it's going down and the volume is leading the price, it just hasn't had a capitulation quite yet. We've actually not seen the volume level at that low until we were at about that price level. That's for Microsoft a long way away. I just think that the market's due and could see continued weakness. When I look at other stocks in this space, in the semis, this is Akamai Technologies. When I look at Intel, INTC, and the list just grows and grows and grows. Here we go. I can't imagine, if all the other powerhouses in this sector are coming down, I can't imagine how it's going to keep the other stocks up. So with that said, there is a very strong word of caution. We've been this cautious for a while. I'm raising the red flags. I really don't have a lot of new actual buy signals, except for I think in the metals and the minings you might see some type of defensive action there. This is a stock called Freeport-McMoRan. The longer-term volume looks pretty strong. It looks like more of accumulation in nature. Seasonally, it has a tendency to bottom going into the June and rally going into the July time period. That's that little short upside that might offer something. XLU, believe it or not, utility stocks, boy, they've just been taken out to the woodshed. But let me point out to you about the utility stocks. One thing is, on a weekly basis, I take a look at this. We just hit quarterly pivot support just on Friday. And I understand it's interest rate sensitive and it shouldn't be that forefront of everyone's mind, since everyone loves biotech, right? No one's looking at utilities, which pay a dividend and could be defensive in a scary downdraft. But needless to say, the weekly stochastics has built in a strong bullish convergence. And look at the volume on that breakdown. It's non-existent. Longer term volume on the utilities still looks relatively healthy. The trend is up. So I think the market is due against these longer term pivots. I think the market is due for a kind of a bounce in the market. I'm just not sure if you want to pick the falling knife right yet versus waiting for more work to come into the market, work being higher highs, higher lows, and look for maybe an acceleration to the upside. Some of the names in the space, AEP, EXI, the list is in our TradeStation professional package. You can go on down there. When we take a look at EIX and we say, well, what are some of the stocks that really really adhere to that volume pattern as to the index itself? This has a little bit deeper of a volume push to the downside, so EIX might not be one of the greatest and the daily volume. So I'll go through a list, and then we'll tweet some out when I get back. But you guys can do certainly your own homework and look at the market in that content. All right, so we've gone way over. I just wanted to share with you a couple of the sectors that it's tough to put out a strong buy recommendation on any stock. Maybe it's time to look at inverse ETFs. This is the XLB, by the way, and I just wanted to clean things up as we move forward. In the material sector, that was a doji. This is the most putrid volume analysis in the content that the price has gone up. Price went up. It hit resistance back in February. It's kind of tried to rally again. The volume's down. It couldn't even come up to its MA, and now we're forming a monthly, not a daily, not a weekly, a monthly low close doji in the materials. Looking at XLY, couple more sectors I want to look at. Here's another one, XLY. Looks great. It's had a strong upside. The consumers, people think the consumers, didn't spend because of the snowstorms, but actually the XLY consumer discretionary sector really did a nice job in performance this year. Problem? It's not rallied on strong volume, both on monthly and weekly basis. While it has been a leadership, it's also entering a seasonally weak period of time. So weekly doji here. Weekly doji back there, stochastics forming potentially a divergence situation scenario. We are at and formed a low close doji at monthly support, so the XLY certainly not looking great. And last but not least, let me go in the XLK and just take a gander at the X's. Engulfing pattern on a monthly basis, monthly engulfing pattern from the prior month. Negative volume on a weekly basis. Seasonally goes down on or about the 10th of July when we get back from our vacation in Italy. Rounding top, daily charts reminiscent of a potential shoulder, head, shoulder. Here's your neckline. Volume actually mirroring shoulder, head, shoulder, and we would be wanting to see a neckline break in the volume pattern as well. So looking at the financials, since we did FAZ, that looks a little bit more constructive in the sense that we did see an upside move. Volume confirmed it. So why would I look at FAZ? Well, let's take a gander at the regional banks. Strong move. Regional banks really broke out. Maybe potentially from the breakout, let's say from price to monthly moving averages, perhaps we moved out a little too far. And let's look at the BKX, excuse me. Oh, come on, John. I'm almost done. KIE, insurers. The insurers has been one of the ones, the KIE is the insurer sector, and the insurer sectors, I'm sorry, I had a little mind melt there. I'm under pressure because I'm way over here with you guys. But if you notice, big move to the upside in the insurers. What is that volume all about? That's a daily chart, weekly chart, monthly chart. So huge move on a weekly accumulation basis. and we just didn't see the volume attached to it. Best time of the year or worst time of the year to start getting into this stuff? It's in a seasonally weak period of time. We would just be looking for the market to roll over. We've got a doji over here. It might close above that high, but watch out for the next month if it's an equal and opposite. What I would be looking at in some of these markets is to see if we roll over and start trading below the prior month's opening range. I think I got time to share that with you when I get back from Italy. After all, I'm only going to be gone Monday, Tuesday, Wednesday, Thursday. Friday's a holiday anyway. So have a great 4th of July. Peace to all. Be careful up here. Tighten your stops. Take some protection. This is now the time to actually listen and not say it can't happen this time. We've got to go. That's about it. By the way, this is the last picture I share with you. This is the VIX. From a seasonal perspective, when is the in the VIX? It is right around in July when it makes its annual low. We've had 2 months back-to-back of dojis, and we typically see as we get from July, September, October, that's when the VIX typically has a big move up. So if you're trading in VIX products, now I'm giving you a time frame to put the green light on bullish neutral strategies in the VIX. Peace, goodbye everybody, and have a safe, wonderful 4th of July.